Good afternoon, ladies and gentlemen. I am Eugene from SIAS. Thank you for joining us at Corporate Connect this afternoon. This webinar is organized by SIAS and supported by SGX. Today, we have with us Ms. Candice Lee, Research Analyst from SGX, to share with us on market updates, followed by a presentation by Mr. Adrian Toh, Chief Investment Officer, Enviro-Hub Holding Limited. And we will end off with a Q&A session moderated by Mr. Benjamin Goh, Head of Research and Investor Education from SIAS. Without further ado, let us welcome our first speaker, Ms. Candice Lee from SGX. Over to you, Candice.
Hey, thanks, Eugene. Just do a technical check. My slides and voice are okay?
Yes, it's good.
All right.
Proceed. Thank you.
Okay, thank you. Right, thanks again. Pleasure to be here today. And good afternoon, everyone. I'm Candice from the SGX Equities Research Team. So today, I will be providing a brief overview of some of the key highlights of the Singapore market in recent times. But before we begin, I wanted to just move on to the next slide and point out that this presentation is meant to be purely informative, and therefore we are not providing investment advice in any way or any form. So with that, let's get started. Yeah. So before we delve deep, wanted to first give an overview of the STI movements this year. So in 2021, year to date, the Singapore benchmark, our Straits Time Index, which we commonly refer as the STI, that has generated about 13% price gains. If you reinvest the dividends, the total return will be boosted to about 16% this year. It's one of the best performing indices in the region. So if you look at if you compare it to the FTSE ASEAN All Share Index, that returned approximately 11% total returns this year. So about 6% price gains. But even in terms of a high performance for the STI this year, STI is still one of the highest dividend yielding indices globally. So if you're looking at a 3.6% dividend yield versus a 3.2 for all world, or 2.0 for the 2.0 for the all world, and 3.2 for the APEC index. But to understand what drove the STI's performance this year, let's first recap the sector classifications within STI. As we know, financial services is a major driver of the index. It's the largest weightage in the STI at 46%. And the three banks already makes up about 43% of the XTI, and they've averaged about, I think, 25% year to date. So if I bring attention to another sector, which is the REITs sector, there are several REITs in the STI, about 14% of the total weightage. Now, the REITs have also been impacted by global sector trends this year and has seen some sector rotations within the subsegments of REITs, so which I will touch on a little bit later. Right. Okay, as said, the three banks, DBS, OCBC, UOB, have always been the key driver for the STI. So far this year, they've averaged about 25% total returns, marginally less than the median of the global banks, but doing well better than the APEC regional peers. Most of the gains that we've seen for the banks were in the first quarter this year on the back of resilient investment activities across the globe, and of course, the generally, if you look at a steeper yield curve back in the first quarter. Recently, last month, since I think it was 22nd September, after the Fed meeting, they've confirmed tapering at the end of this year and a potential rate hike that is going to happen sometime around next year. So from then, the yield curve did steepen a bit. I think it was trading around 100 to 105 bits in September. I think it's now well above about 200, 125 bips right now. And this has also brought the returns of the three local banks up another 6% since then. But in terms of dividends, not just if you don't just look at performance, but also at dividends, many consider the banks a high yielding play. So their average dividend yield, if you look at this now, is about 3.3% now for average, beating some of the other regional and global peers. If you recall, just about 3 months ago in July, MAS lifted the dividend cap on local banks and financial institutions in Singapore. So to recap, actually last year, 2020, MAS capped dividends for financial year 2020 at 60% of the bank's FY 2019 amounts, and asked banks to offer shareholders share dividends instead of cash. So one of the reasons for this is that this is a preemptive measure at a point of time to ensure that the FIs, financial institutions, and banks, they maintain strong lending capacity so that they can support the economy throughout the uncertain pandemic last year. Now, this year, the cap has been lifted, and all three banks, they've actually declared interim dividends in August. So we're seeing payout ratios close to 2019 amounts. So theoretically, if we just do a calculation, if we assume that the three banks distributed their pre-COVID 2019 dividends this year instead, then we're looking at yields based on, I think, yesterday's closing price. We're looking at yields that is about 1% higher than these yields over here. So it's about 3.9 for DBS, 4.4 for OCBC, and 4.8 for UOB. So now third quarter earnings season is coming. Focus in the next 2 weeks will probably be on the earnings results. And all three banks, they are due to report their third quarter business updates in early November. If I remember correctly, it's about 3rd November for UOB and OCBC, and 2 days later, 5th November for DBS. So the analysts and investors community generally will be looking at insights into their 2022 business guidance, and we expect that focus should be on credit costs, sustainability of their loan growth, and their fee income momentum. Right. So moving on from banks, another ongoing market driver this year has been the development of COVID-19 economic recovery. Vaccination rates continue to be important, as well as the transition into a new normal that many countries are pursuing, and so is Singapore. Advanced estimates for Singapore's third quarter GDP were released, expanded about 6.5%, and so full year estimates have maintained for about 6 to 7%. Before COVID, tourism has always been a key major contributor to the Singapore economy, and the significant decline last year has impacted many of the sectors: shopping, accommodations, hospitality, F&B, entertainment. But with the recently announced VTLs, expansion of VTLs, we've seen some advancements in the travel and hospitality sectors on SGX, which I will delve a little bit deeper in the slides after this. One last one before we move on, it's FX, right? Foreign exchange rate have always made a key difference in investment returns. So another notable announcement last week was from MAS. So MAS slightly raised the slope of the policy band of Singapore dollars nominal effective exchange rates there. It was at 0% for the last, I think, 1.5 years, right? If you look at the slope over here, they've maintained the policy bandwidth unchanged, and this was actually in contrast to consensus, which expected the tightening of policy to only happen next year. Now, some key motivators for raising the slope now, MAS noted that over the past 6 months, right? This has been fluctuating above the upper half of the policy band. So it reflects a partial shift of sentiments around Singapore's macroeconomic outlook as the pandemic evolves. Another factor, inflation, is also quite key in consideration. So for 2021 as a whole, the MAS core inflation, they're expecting that it will come near the upper end of the 0 to 1% forecast range, and is expected to grow further to 1 to 2% next year. This will be on the back of an increase in global commodity prices in recent months, which has been passed through to electricity and gas tariffs. So all these factors have come into play, which resulted in many of the movements of the Singapore stocks recently. As I mentioned, the commodity prices, right? So some key trends that we have been seeing this month. It's oil and coal prices rallied on the back of energy supply crunch from China, from India, especially as winter is coming. Now, since the start of the year, prices of the Brent crude oil has rallied about 100%. This is in SGD terms, it's up about 100%. WTI up about 80% this year. Oil prices, it crossed the $80 per barrel for the first time since 2014 and maintained above this level for the most of October. So more recently, we've seen actually oil prices has been rising since Tuesday, recouping some of Monday's losses because concerns around China's falling temperatures, right? There's supply concerns to meet heating demands as winter approaches. Now it has been, oil prices has been above $85 per barrel since the last 3 days. On SGX, we have two oil and gas explorers and producers. They are among the top traded stocks in Singapore. You're looking here, we have Rex International and RH Petrogas. Both of them have seen triple digits total returns this year. I think net institutional inflows have also been significant, about 16 million year to date. And some recent developments, if you're following, Rex announced on Tuesday that they would be seeking to transfer its listing from the current Catalyst board to the main board, since its market cap has crossed the 300 million mark. Now, similarly, coal prices, the supply crunch in coal has also sent coal prices rocketing since, I think, lows of last year. We have three SGX listed Indonesia based coal explorer and producers. Two of them actually export a portion of their coal to China, Golden Energy Resource and Geoenergy. So both of them similarly triple digits gains since the start of the year. Black Gold Natural, they do not export to China and they supply mainly domestically in Indonesia. So saw slightly muted gains compared to the other two. Right, actually, if you look at the portion of export to China, I think FY20 last year, Geoenergy, they export about 66% of their revenue to China, which is quite a significant portion. Golden Energy is about, I think, 30%, a third of their revenue to China, so also pretty significant. So coal prices has been following developments in China, but this year we've seen a slight turn of events. Coal prices fell slightly yesterday after Chinese government hinted that they may be intervening because should coal prices keep rising too high. So coal prices this week fell a little bit, 3 to 4% this week. Similarly, the three stocks over here also was down about 4 to 5% in line with coal prices. But even so, the year-to-date gains has been above 100% this year. So I guess government measures on energy prices, will be oil, coal, it will be something that analysts, investors will be looking out for in the following weeks. Moving on, like I mentioned, REITs also a key driver this year. Also one of the top performing sectors. I think what was interesting is that third quarter, last quarter, June to September, we've seen net institutional inflows into the REITs sector. What is interesting is that actually for the 9 months prior to that, since October last year, there has been consistent institutional outflows out of the REIT sector. And institutional investors actually returned in third quarter. I think there's been inflows of over 250 million Sing dollars into the sector combined. I think one of the driving factors last quarter for REITs would be the index inclusions. So in September, FTSE Russell announced that 11 SGX listed REITs and property trusts, they've entered the major REIT benchmark, which is the FTSE EPRA Nareit Global Developed Index. This was actually following from a index rule change back in June this year. It lowered the market cap threshold for inclusion. And we've seen huge trading activities into some of these REITs recently. If you look at the recent top performing REITs for last quarter, all 5 of them, they are actually recent inclusions into this particular index. I think another topical news this week would be REITs merger. So ESR REIT, ARA logos Logistics Trust have also announced a potential merger. So the combined entity, the two of them, if they merge, they would propel it into the top 10 largest REIT by free float market cap on the exchange. I think investors should be focusing on the potential access to the new pipeline should the merger comes and by the new sponsor, which is ESR Group, who acquired ARA back, I think, last month. So REITs, like I mentioned, there's a lot of different sectors and segments within the REITs, right? Particularly retail, hospitality. We've seen some of them rally on the back of the announcements by Prime Minister last weekend, right? When they say that we're transitioning to a new normal, and the announcement of new travel lanes coming to Singapore. So post the announcement, 10 of the most traded stocks on SGX that is relating to the travel and hospitality sector, right? So, these are some of the names. These are 5 of the names. So most of them actually rallied quite a bit. And the one that actually went up the most was Escort Residence Trust, also a REIT. They're up 9.6% since that announcement. SIA, SETS, SIA Engineering, ComfortDelGro, Genting, are also some of the stocks that have rallied quite a bit on the back of the announcement. And it's also some stocks that investors have been focusing on recently. SIA, it has been the best performing stock this year among the 10 over here. They also noted that actually they've expanded flights into VTL countries recently. So they would be looking out for the potential transition into this new normal and opening up of the borders next year and this year. Actually, aside from the few REITs that you're seeing over here, Escort, CDL, Far East, Hospitality, SGX also have actually 2 other REITs, Fraser's Hospitality and OUE Commercial REIT. So the 2 of them are also have exposure to the Singapore hospitality sector. So, with the rollout of more vaccination, booster shots, recovery of leisure travel, we could be focusing a little bit more on this kind of stocks over the next few weeks. I'm aware of time. I wanted to leave more time for the next presentation by Adrian, especially Enviro-Hub. So this would bring me to the end of my presentation. All of our research content can be found on the SGX website. If you scan the QR code over here, it should bring you there. But if you want the latest updates at the tip of a finger, do subscribe to our Telegram channel. It's called SGX Invest. So with that, I will stop here and hand back to Eugene for the next presentation. I'm looking forward to Adrian's presentation.
Thank you, Candice, for sharing. And next, we are pleased to welcome Mr. Adrian Toh, Chief Investment Officer, Enviro-Hub Holding Limited. He will share with us more about the company. Sir, please.
Hey, thanks, Eugene. Hi, thanks, Candice. Okay, let me share the screen first. Yeah, will you be able to see?
Yes. It's good.
Okay, great. Okay, hi. Thank you, everyone, for dialing in this, joining us for this call. And then I'm the CIO of Enviro-Hub Holdings. Today I'm going to present you about our company, and we just explain to you what we actually do and let the people know about our company. So we are listed on the main board on the SGX, and the company is majorly controlled by our group chairman, Raymond Ng, with a 34% of 7 stake in the company. And we have 4 main key business of the company, which is trading, recycling, and we have piling contracts, and we also do supply and manufacturing of healthcare products, as well as the property investment. Moving forward, we are going to streamline our 4 key business into 2. This is our good directions, and we've been trying to position ourselves into asset-like company, which is now we're going to focus ourselves into trading and recycling, and as well as the healthcare and products. The reason why we want to actually exit from the piling contracts is because this was our legacy business, and also we want to recycle most of the capital from the piling contract into these 2 new business, as well as the property investment business, which is to us is a low ROI business, and we are looking to recycle into a higher ROI business. So I'm going to focus 2 key business today, which is healthcare products as well as recycling. So I'm going to kickstart the healthcare products. We are okay, Enviro-Hub, currently we own 25% stakes in the PASTEL glove, which actually manufactures and supplies gloves mainly in to the medical segments and to the F&B establishments. We do latex and nitrile and specialty products. Next week will be our EGM that we will pass through the 75% acquisition for the remaining stake in PASTEL glove. After the EGM, we will fully control the PASTEL gloves 100%. And moving forward, our vision is to become a leading integrated healthcare supply chain, mainly into the PPE and masks. And for us, we are hoping to move up to the upstream, which is the chemicals. And apart from that, we're also looking to a horizontal expansion, i.e., we are going to move ourselves into not just doing a glove, but we're going to do more PPE and masks. And besides, we're also trying to move ourselves into more downstream, as we know that downstream is actually a place where we can actually distribute our products. And we are in the midst of expanding ourselves to a distribution channels. And we will certainly announce in the due course when the plan is firm. So I guess a lot of people will be asking us, where are we into glove business? And people probably were just thinking that glove is very competitive right now. But today I'm going to explain to you how we differentiate ourselves from others. In the market, there will be noticed that there will be actually flooded with a lot of the glove right now, which is mostly in the 3.5 gram glove. The 3.5 gram gloves are mainly from the nitrile side, which is actually coming from China. Given that the nitrile price actually came off substantially from China as there were more supplies coming to the market. But for ourselves, we are not focused on just nitrile products. We are focused ourselves into a specialized products. How we differentiate ourselves is for specialized products, we are doing mostly on the heavier weights and long cuff gloves. Heavier weights are all like more than like 5 grams, 7 gram, 10 gram products, and also a long cuff glove, which is we are going to focus more on the anything above the 240 mm. This is differentiate ourselves from others. As the price for nitrile has been coming off, we actually see that the prices for specialty product be holding very well. And then given that there's not much competition in that segment, and there's not many new players that are able to compete in the segment, as you definitely have to go through a lot of the know-how and have to go through a lot of the learning curve before you will actually excel yourself into this specialty glove. When the price started to come off, it kind of benefit people like us as we are able to actually stand firm into the specialized glove, while we are actually seeing more new entrants are actually exit the market one by one as the price started to coming off. So we are looking to more of the brownfield acquisitions, and if we start to see more players exit from the market, we'll start seeing that there'll be a more consolidation in the market. That ourselves is we are looking to looking for more M&A perspective. So as mentioned, the top 5 OEM manufacturers in Malaysia, they're producing 3.2 to 3.5 grams of the nitrile glove, while we are actually focusing mostly on the specialty glove. While there's a lot of the China manufacturers are adding more capacity into this, what we say the low-end products and lower weight glove like MBR and vinyl, and we are actually focusing ourselves into more on the specialized products. We're actually seeing that there will be actually more and more demand coming from the heavyweight glove, as more and more medical company actually aware that there will be actually lower grade products that due to this awareness of after this hygiene and awareness from the COVID, people are shifting towards more on the heavyweight products and they want to protect themselves from the COVID, and the lightweight products is not able to shield themselves from that. So we start seeing that there's a shift moving towards the specialized products. This is actually the product mix of our company. Right now, we are actually doing 80% of the specialties like I mentioned just now, and 20% in the latex. This is an interesting fact, as you will start seeing more demand coming from the latex products, even from China, as China will not be able to produce the nitrile gloves, as the MBR only available in China, but latex is not available in China. Therefore, they will not be able to produce latex glove in China. Hence, we actually see more demand coming from China, and we actually see that there's a spike in prices as well in the latex segments. So we're quite proud of ourselves in that we are quite agile in switching ourselves in the products, as apart from just focusing on these nitrile products, because we are consider ourselves as a small players, and we are able to fine tune our machines and to cater to more customer needs. In this sense, when we see there's actually more demand coming from China, we are actually able to kind of like configure our machines to actually cater to the needs of China. And we start seeing more demand for the specialty glove as well. And then we are able to customize what is a requirement from the customer as well. So with the custom leads and everything, that actually differentiate ourselves to the other players as well. Besides that, we also try to focus more on the branding. So I've been trying to emphasize is like you start seeing the price for the glove to come off, but if you go to the pharmacy chain, you will realize that the price for the branding stuff actually didn't come off. The reason being that a lot of consumers still recognize the brands. So brands like 3M and Cell, these are all the key brands in the markets that the prices didn't vary much as compared to the pre-COVID level. The reason being that they have a very strong brand connections, and the only player that suffer is actually OEM, where the brand owner has more bargaining power is coming from there. So for us, we have been trying to focus and to switch ourselves into the more on the brand. We want to aspire ourselves to become brand owner. Therefore, as mentioned just now, we want to also strengthen ourselves into the distribution channel side. So yes, we are actually trying to create these brands right now, and then we start seeing there's very fruitful results coming from there. Just a little bit lights from why we think that we can excel into the brand ownership, because our current partner, Harry Lau, he used to be the founder of the latex partner, which is actually one of the largest glove company in Malaysia. So he used to actually own this brand called Black Dragons, which subsequently sold to Microflex. And with his experience in creating the brands, we believe that we are able to actually create another legend brands in the markets. So we are actually in the midst of doing that, and we believe that we will certainly bring this to the price to the market in the due course. So for the ASP right now, you will start seeing that the price for nitrile been trending down, and latex price is actually moving, coming down, not as steep as like nitrile glove, given that nitrile is actually it's all being flooded by the supply from China. And moving forward, what's our view is we think the price will actually stay where it is right now, because for latex powder we are looking at about 28 to 30, and nitrile we're looking at about 35 to 40, and the FDA, and we believe that it will be above 45 to 50. So the reason why we think the price will actually stand firm right now is because of the China, due to the disruption of the electricity in China, we start seeing that there'll be more supply being disrupted in China, as well as port congested issue, that a lot of the stock and inventory being digested at the distributors. So we will start seeing that there'll be more ordering coming in the beginning of next year. So I believe that in the next 2 months, after the market start to digest all the stocks and inventory, we'll start seeing that there will be more orders coming from there. And the price is actually going to be standing from there, as there's another key reason is being the gas price has been spiked up by 35%. So you will start seeing more and more small players out from the market, and whereby the big players are it's not going for the price war anymore, because given that the prices for electricity and as well as even gas and coal price has been trending up. So there's no reason for them to keep on slashing price to gain the market share, whereby the quality is actually not there. You will start seeing there's more return from the customer. So in this sense, we start believe that the price will start to stand firmly from here, and this will benefit us more as we start seeing the raw material came down substantially, especially NBR. For the NBR, the price beginning of this year was 4,200 per tons, but today the price is 1,600 per tons. So where people may comment that the ASP for gloves actually coming down, but the cost actually coming off substantially as well. So to sustain yourself into this environment, the only way to survive is to first to make sure that you have a better efficiency of your productions. The second is to control costs. This is the way of protect ourselves and to keep ourselves more competitive in this environment. For us, right now, what are we different from ourselves from other sport player is our gas price is actually at least 30% lower than others. Given that currently our factories located in IPOH, we have all the gas pipes ready there, and with the gas pipe, they actually save around 30% cost from all the makers which use the LPG or LNG to produce the glove. This is a very key differentiation factors, especially when the price starts to come off, as we will make ourselves even more competitive. So that's about the glove. And right now I'm moving to our second key business, which is the trading, recycling and refining of e-waste. So what is e-waste? E-waste is basically the iPods, all the used phones, and even like all those memory chips and all those motherboards, hard disks that is all used electronic products that lying outside. So that's what we call e-waste, electronic waste. So our business model is like this. Enviro-Hub, we actually recycle this e-waste, and people probably do not know what we actually do. So today I'm just explaining what we actually do. So the MNC will sell the e-waste to us. They will sell the e-waste like just I mentioned, those memory chips and even the hard disk motherboard to us. So when Enviro-Hub got the products, so we will start to recycling process. So we will take out all those parts and everything. So 64% of the parts we will sold as a scrap by kilograms, and 50% of the parts usually we'll just dispose it off because it couldn't be recycled, and 20% of the base metal like copper, this is all that we can, aluminium, we will be able to recycle. So we will actually recycle it, and another 1% less other gold. So gold will go for the refining process and to extract the fine gold, and we actually export to countries like China, Hong Kong, and Europe. And this is our business models. So why we think we are different from others, and why we think that this e-waste will do better right now with the awareness of the ESG, and also getting more users getting more environmental friendly. So we start seeing that there's more MNC started to engage us for the e-waste. The difference between now and last time was the last time we had to buy the e-waste from the MNC, because MNC previously know that there's some very valuable components like the precious metal and base metal content in the parts. So they actually sold to us and hoping that they are able to recover some of the costs. But right now, given the environment is changing, then there's more awareness of the ESG. Right now, they actually pay us to actually get the e-waste from them. So this is the two differentiation factors right now that we start seeing there's more rising demand coming from the MNC. So we also be a beneficiary for the recent spike in the metal prices. So you're probably aware that the commodity prices been trending up, especially the steel price, copper price, and even the precious metal as well. So we have been benefited from there, and we'll start seeing this trend to continue for at least next few years. So this is the reason why. And we also expand our processing capacity by more than 40%. And currently we have like expanding from 3,600 tons per year to 5,100 tons per year. And our expansion is expected to be completed by the end of this year. So as mentioned just now, so you'll see that our profit previously was actually trending down, given that we had to pay to actually get our e-waste. But moving forward, we believe the trend is going to change as we're going to be paid to actually get the e-waste. So that is a game changer for us moving forward. And previously, our margin is very much determined by the movement of the commodity prices, because we had to buy this e-waste from the MNC company. So right now, we had to also sell our products like gold and copper based on the market prices as well. So our margin is actually pretty much depends on when we actually sell our e-waste, our output, such as the gold and silver and other mixed metal. So, but moving forward, things are going to change as we definitely get the fee pay, and then the movement of the commodity prices, it will not be a key needed to actually it will not be a key factors to actually change our revenue. So just a quick overview of our results for the first half. So the key highlights here is actually our net debt level. So ever since last year, we started to kind of change our direction of the company, as we mentioned that we want to focus more on the asset-light business and also to focus more on like the more lucrative business. So we actually we actually sold our some of the asset and some of properties to actually bring down our debt level. So our investment properties, we are still sitting on big investment properties, and which is amounted to 64.2 million. Our intention is to dispose of the entire sum and after that we're going to be just recycle this amount to our two key new business. So moving forward, we'll be start thinking about the dividend policy next year, because given that our net debt level has been powering down substantially, and then next year we are hoping to actually become a net cash company, and we believe that dividend policy will be in place next year onwards. So in the future, so we're going to focus these two key business, and we believe that we continue to do well in these two segments, and we believe that with the rising of the ESG as well as the awareness of the hygiene, we'll definitely excel into these healthcare products. So just a quick to show you that this is a history of our company. Previously, we were actually into the piling contracts, and we moved to the recycling business in 2005 by injecting HIS, environment, and similar into the company. And in 2013, we forayed into a property investment company, and in 2021, we actually forayed into healthcare supplies. But with our direction change is, given that in 2013, you probably know that the property company is property environment is actually quite rosy, which is compared to right now. We believe that the property price may not be as rosy as it used to be, and ROI may not be as good as used to be. So we are looking to recycle our capital into like more or better ROI to award our investor. Hence, we are actually venture into the healthcare products. So what is next? The next will be definitely we are looking to move into the upstream in the healthcare spaces, and certainly we will make further announcement once the plan is formed. He's our group chairman, Raymond, and he has a very vast experiences into recycling and e-waste. For me, myself, I in charge into mostly into healthcare products, and I was a fund manager previously. And this is our CFO. And yeah, that's about my presentation for today.
Thank you, Mr. To. We will proceed to the Q&A session. You may post your question in the comment section below, and due to time constraint, we will endeavor to answer them. Can we have the moderator, Mr. Benjamin Goh, Head of Research, SIAS, and Mr. Adrian To, Chief Investment Officer, Enviro-Hub Holding Limited, to kickstart this session.
Well, thank you very much, Eugene. Also, a warm welcome to Adrian. Good to have you here. I think this is the first time that we have Enviro-Hub, on our Corporate Connect. So, very warm welcome. We do have a couple of questions that's come in through our Facebook page, and we're gonna get to that. But I do have a burning question to begin with, and this from the perspective of SIAS. So for the last 18 to 24 months, we've been, plagued, or rather in the throes of the COVID-19 pandemic. And it's quite interesting to see that Enviro-Hub has embarked on this pivot or transformation of its businesses, specifically the restructuring into two separate operating segments, the recycling of e-waste as manufacturer or PPE. So the question is, did the COVID-19 pandemic was it a major factor or motivation to propel Enviro-Hub into pursuing these two separate areas? And also the secondary question would be, what are the driving factors behind the proposal to dispose of its property and piling segments?
Okay, great. Thanks for the questions. So for the first questions, for the supply and these PPE products, actually our group has been always looking to diversify into the healthcare segment for quite a long time, given this long-term prospective demand for this sector, because due to these aging populations, but and this pandemic is just kind of like speed up the whole process of the transformation. So we just that's actually it makes much more sense to it that we believe that it will be a right time for us to actually transform in this segment, that people will be more receptive to this idea, and our investor will actually understand the rationale behind. And it's just a coincident time happens. And whereby for the property segments and piling segment, okay, as mentioned just now, a property is I would say that for our group, because right now we are trying to be more on the asset light, because we try not to sit on too much asset right now, and we believe that this will actually drag down on our ROI. So we want to actually bring out our ROI. Therefore, we try to recycle more this capital into like a better margin of the products. And property, if you just calculate our property for the Lansun building, you realize that our yield for the rental is about like 2 to 3% kind of per annum. So that is not kind of sexy for like an investor. So after you probably minus out the finance cost, you probably bring you down to kind of like below 1%. So we believe that to recycle into like this PPE healthcare products, that will actually give us a better margin. So that will kind of better reward our investor. So that's the reason why we want to move out from there. And for piling contract, is actually piling business is our legacy business. We always want to kind of like dispose this business. So it didn't really contribute much to our group right now. And so we just leave it there. And whenever there's actually a right buyer, we definitely want to dispose all the business. And with that kind of the cash considerations, we'll kind of like recycle these two new segments.
Okay, thank you very much for that. So it sounds like the COVID-19 pandemic was, I suppose, an opportunity, a good timing to make the pivot. And also, as I was, listening to your answers, it struck me that your background as a fund manager, I think that probably fed quite a fair bit into the business decision. The way you explain your decision and all that. Okay, thank you very much for that. Let's move on to the next question. There is, and this is related to your presentation just now. So coming in from Facebook, there is a lot of news recently on the drop in demand and price of gloves, especially the normal healthcare gloves. I guess this is the normal PPE equipment, with respect to COVID. However, what about those heavyweight gloves that you had mentioned in your presentation? Any impact on the profit and demand for those?
Actually, for the lightweighted products, in fact, we start seeing almost like the price trending down almost every week. But I think the differences is like, even though we try to sell our, for us, we actually see the opportunity. Okay, what the reason why we say that is, there is actually opportunity in between, as there are a lot of the very low end products in the market right now. So a lot of the consumer outside, they are actually looking to buy better products. So they are rather to pay a better margin, like kind of the premium prices to the this glove. So what we actually see is like we are actually kind of like earn the arbitrage in between. So we are able to kind of like source. We know that there's a better products supplier. So while we don't manufacture ourselves, we just be a trader like in between. We're just looking to actually just kind of like be the middleman. So just to buy these better products, and we sell to the consumer at the kind of like premium prices, because the consumer trusts us, that they believe that we were able to kind of like supply them with a good kind of like quality of products. So while our manufacturing sites, we don't want to manufacture those low quality products, or maybe rather I would say the low weighted products. So the heavyweight products, in fact, right now we really see a lot of the demands piling in, and our actually our contract is actually piling up to next year January. So we didn't see this actually coming down. In fact, the prices we do actually adjust a little bit because of our MBR prices as come off. We want to kind of like we're still able to maintain that kind of margin because we know that right now we don't look at percentage of margin anymore. So in the market, we use dollar. Like example, by manufacturing this, I want to make a $30 from it. So when our material price start to come off, as long as I maintain that kind of like the $30 margins, so I'm actually good enough. So I will use that to actually kind of benchmark against like our ASP. So yeah, the heavyweight product, actually the ASP doesn't come off, but the margin in between, we are still able to kind of protect. While at the same time, we are still able to do our trading business because we will start to become a trader. And in between that, we're trying to kind of like match make quality products with another, another customer. So that will give us another kind of income stream. So we actually see it as an opportunity rather.
Okay, that makes perfect sense. So rather than to be one of those manufacturers that deal with the low-end products and low-margin products, you want to be high up in the food chain, I suppose, to be able to manufacture the more value-add kind of product. Okay, thank you very much for that. We do have a next question. What is the kind of margins we can expect from recycling of e-waste given the change in business models?
Okay, the kind of margins we are able. Okay, right now our margin is below the single digit. It's a high single digit, but we are looking at a double digit. Maybe I would think about above teen, high teen kind of margins.
Oh, okay. All right. And I guess related question is we do have a participant in this seminar who have a question really about the business model. So may I know why MNCs have to pay you to dispose of the e-waste instead of selling it to you like before? What has changed?
Okay, sure. With this ESG, right? I think probably you can have a search on this, something called extended producer responsibility. Is what we call EPR. So this EPR actually law will require the manufacturer to establish a fund system to recycle or collect those obsolete products. So previously they don't really have this EPR in place, but right now with this ESG coming out in place, right? So this EPR law started to be there. So in fact, for every single product that they produce, they have to set aside funds to kind of like recycle this product. So it's already set aside funds. It's not that they purposely have to pay you, but they have to set aside anyway. So this is a different as compared to like, let's say you're talking about 2 to 3 years ago.
Okay, so sounds like regulatory change has presented an opportunity for specialized players such as Enviro-Hub to handle the recycling part of it in a safe and I guess environmentally friendly way. All right. I guess that's in line with global trends towards sustainable consumption and energy use and so on and so forth. Okay. Let's talk a little bit about the capital structure of Enviro-Hub. So, given the growth plans that you have outlined in your presentation, how does Enviro-Hub seek to balance the interests of growing its business as well as rewarding its shareholders through dividends?
So okay. If you notice our group structure right now, we are going to change it in a way that right now we actually establish Enviro Healthcare and this is maintain the Enviro Holding. So holding will be on the top of the company. So what we're going to do is we will start actually from our subsidiary to kind of declare the dividend to the holding company. So from this part, from the company perspective, we started to build this structure whereby we'll start to distribute dividends for orders like the unused capital and to the holding company, and the company will start to distribute this all to the investor. But at the same time, for Enviro Healthcare, right now we don't need like additional capital infusion from the holding co. And what we're going to do is we're going to recycle whatever earnings that we earn from there, and then for us we'll kind of distribute 30% of the payout to the holding co, and we'll reserve 70% for our other like business potential and the prospect as well. So the 30% will go to the holding co, and the holding co minus all those like the expenses, everything. So they're looking to distribute 100% to the investor.
Oh, okay.
That is that's our plan moving forward.
Oh, okay. So I guess the net is that the PL ratio will be slightly below about 30%. Right. Okay. So sounds good. Sounds like management has got a plan to balance both the needs of growing its business as well as to provide a decent what you call dividend yield to its owners. Okay, that's good. We do have another question coming in. Let me see. Let me just quickly read it. So this participant during the presentation said increase in capacity for your recycling of e-waste, and the profit will grow at a much faster rate since the margins going forward is mid-teens and more capacity. What is the growth for this segment in the first half, and is it going to be profitable in the second half of next year?
Yeah, certainly. We actually see this this segment will be much more profitable as compared to the all the previous quarter. And then like I mentioned just now, yes, we start seeing that there's margin extension coming from there, and we also lock in more contracts from the MNC. That's the reason why we actually expand our capacity, and we believe the capacity will be filled quickly with all the contracts, and yeah, we'll certainly see a better kind of like the profitability in this segment as compared to the last 2 years.
Okay. All right, moving to a slightly different but related topic. So apart from the group's strategy in terms of the two separate operating segments, would you be able to briefly explain how the group as a whole intends to address ESG concerns about its operations? I guess specifically because Enviro-Hub is in the business of recycling e-waste, right? Itself is, I suppose, I'm guessing, I'm not an engineer, it's a little bit of a dirty process, right? You need to pull out all the different components, so on and so forth. So, the proper disposal of waste, the sourcing of raw materials, so on and so forth. So your thoughts?
Okay. All right. These two segments, I would think that the ESG is not on just confined to like on the environmental. So for us, okay, SG, and certainly we are actually trying to be on this part like governance, and that's how we actually start to engage with more investors as well. So so social, we actually doing more social responsibility things, like we actually do donations, and we actually like even our products like our glove. We in fact in Malaysia and in Singapore, we are being like actively kind of like donate this glove to a lot of the needy. And we also do a lot of the hospital, especially during this hard time. A lot of the hospital are actually facing a shortage for the glove. Though the prices for the glove actually came off, but they couldn't find a quality glove. So in fact, we're trying to kind of like do the kind of the social responsibility work for that part. So for the E side, environmental. So for glove perspective, in fact, that we are trying to actually do R&D process, that we are looking to kind of like recycle those scrap products. That is what we are actually doing, because I think many people do not aware that actually the glove, a lot of unused glove in the market right now that we just kind of like throw probably in the landfill. There's no environmental, people don't recycle it. So we are actually doing the R&D research on this part, that how we actually convert this thing to certain like something that is useful. The reason we need the recycling arm to actually help us to do the R&D. That's why we see a synergy from that part. So that is actually, I would say that, because you know that nitrile is unlike latex, that you cannot be recycled by just doing that. So we actually found a way to actually recycle it. So that is actually something that we are doing. And then we believe that this will actually help the environment, and also the water treatment. Because I believe that a lot of people do not aware that actually glove manufacturing, they create a lot of the hazardous things. Like example, so for us, we do not actually produce any of the chlorinated gloves. Chlorinated glove is actually very harmful to the environment. So we only do polymer. So probably we are the only player in the market that are actually doing the polymer that part. So that is actually our differentiation factor. The other one we want to mention is the color. So a lot of the glove in the markets right now, actually, the color is actually is not a what we say a oral care color. So oral care color is meaning that you are able to use it orally, and that's not harmful to the body. So we are actually in fact the first in the market for the glove maker to actually use it, which is with the FDA approved color to actually use it on the glove. So we know that this is actually okay, once you really dispose out the glove, it will not be harmful to the environment. So that's the ESG perspective we are doing actually. So it's more on the product basis that but maybe a lot of consumers do not aware. Actually, we are trying to focus on that part. So moving forward, when we come with our own brands, you can see for all the box itself, we will have that kind of certified from the different authority that kind of certify us as environmental friendly. We use the FDA approved colors. Our product is a very environmental friendly colors. And the boxes itself, we trying to improvise our boxes that we don't use so much of the tree. The kind of things. This is our ESG perspective. But for environment, for our recycling segments, so yes, after remove all those things, we have to make sure that we are properly properly have to remove all those parts, just throw in the landfill. We actually have to properly kind of like engage approve personnel to kind of like handle our kind of the remaining waste from us. So that's the thing that we are trying to do. So this is the ESG perspective right now, but certainly we are going to strengthening on that part as well. So yeah, we're certainly moving that direction.
Okay, in the last 2 minutes, I certainly learned a lot more about gloves in the last 3-4 months. Okay, in the interest of time, we do have another one question that we need to, or one or two, depending on the amount of time. Okay, what is the synergy between the healthcare as well as the recycling segments?
Sure. Okay. Actually, we in the healthcare side, we actually do glove, and we're looking to do PPE as well. So for the glove parts, because right now we also do clean room gloves. So a lot of the customer actually they are like MNC customer. They did a lot of the clean room gloves. So in fact, we see the synergy from there is we actually from the Enviro holdings, when they are recycling side, the customer are mainly from all those MNC. So they actually made inquiry via the Enviro site to actually procure the this clean room glove from us. And for us, because we actually sell a lot of gloves to a medical company. In fact, we actually see there's a lot of inquiry coming from our customer from the medical side that they want us to help them to actually recycle their machine equipments. So that is actually a synergy we create for that part. So that's like a cross-selling kind of services and products as well. So that's a key synergy. And the second dimension just now is where the recycling side is able to help us to kind of recycle the products, the unused product from the glove side, which is that is a synergy from the ESG standpoint.
That makes a lot of sense, actually. Yeah. Okay, and I guess in the interest of time, we have got one last question. What is the current and expected, current, I guess, 2021 and expected 2022 margin contribution from both of these different business segments?
Okay, for the margin for glove, we are always trying to maintain about 20 to 30%, given the price came off and everything. So we are still looking at 20 to 30% margin for glove businesses. But moving forward, we are going to move the upstream, and the upstream will definitely give us a better margin. So we are looking about, at least we're still trying to be more conservative, at least 20 to 30%. And whereby for the recycling, we are looking at the teams that I mentioned just now.
Okay, thank you very much. And again, on behalf of our viewers out there, I want to thank Adrian for sitting down with us and explaining the ins and outs of the company Enviro-Hub. All right. So Eugene, I'm gonna pass over the mic, I suppose, to you.
Thanks, Ben and Adrian, for being with us this afternoon. We have come to the end of today's webinar. It's been a pleasure to have you with us today. In case you missed any part of today's session, you can rewatch the webinar on SIAS Facebook page. And do like our page and check out our website to get updates on our upcoming investor education programs and initiatives. Thank you and have a great day ahead.
Thank you.